Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohammed El-Arian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. All right, welcome back to another episode of Forward Guidance. And joining me today is Jeff deGraaf, who is the founder of Renaissance Macro Research. Jeff, it's really great to have you on the show. How are you doing?
Good, Felix. Thanks for having me.
Yeah, really excited to have you here. So as it's your first time on the show, we'd just love to have you just give a little bit about yourself, how you approach markets, and what's your overall just macro framework for how you think about it.
Yeah, sure. Well, I've been doing this for 35 years now, so that's it's as hard for me to say as it is probably to hear, maybe harder. Look, and I came to the markets like everybody else does, or most people do, which is from a fundamental discipline, thinking about free cash flows, thinking about enterprise values, et cetera. So my formal training as a CFA charter holder is in fundamentals, but I became disenfranchised with the fundamentals, not because they were always wrong, but just it was almost overwhelming, how to differentiate between different things and whether or not it actually made a difference, right? And so what I was finding historically was that technical analysis and trends and kind of the probability theories and statistics were really an important addendum to the fundamental story. And so I really went down the rabbit hole and, became labeled as a technician, started at Merrill, ended up at Lehman Brothers right before the bankruptcy. I left there in 2007, went to a firm called ISI, which is now Evercore. And then in 2011 started Renaissance Macro, which will be the 14th year here coming up on the Pi Day, which is about a week away. So that's the short version of my career.
You guys put out some really great work. We've had Neil Dudd on the show a couple times now, and he's had some very excellent calls over the last couple of years of fading the recession calls back in 2022, 2023. And I know he's a bit more concerned on the growth outlook now. So I'll be very interested to hear about contrasting your views and how you things as a bit more of a market practitioner and technician and see how we can bring that all together. So yeah, super excited for that. I will start with, you actually sent over a chart pack, and I just want to pull up your quadrant framework here to have that level set of just, how are you viewing the markets today? There's a lot of different moving parts in terms of the growth outlook and the inflation outlook and how it all comes together into markets. There's, headline risk up to the ceiling these days. So I'd just love to hear about, framing up this conversation of this quadrant and how you're thinking about it right now.
Yeah, well, look, one of the things that we do is we are market practitioners, right? We're not economists. And so I think one of the things that economists do, and frankly, a lot of investors, is they have this default that whatever's happening in the economy must be happening in the markets. And that's not always right. The markets tend to be a lead mechanism. That's why they're really so tricky, because a lot of times when they're bottoming or starting to accelerate, the news is almost as bad as you can possibly imagine, right? So one of the things that we did here, this is what we call our market cycle clock. And what we're doing is we're juxtaposing a proprietary inflation measure, which is, using the inputs that, again, not really were important to the economy per se, but were important in forward forecasting the S&P. And so we created our own inflation measures and then did the same thing on the x-axis, which is growth. And what you can see here is historically what these various boxes represent. We color coded them based on statistical significance to forward returns for the S&P. And this is on an annualized basis. So what you'll note is that inflation actually tends to be a lot more important than growth. That inflation, almost regardless of where it is in the matrix, inflation, almost regardless where it is versus growth, is a pretty big deterrent to forward equity market returns. Conversely, the lower inflation, even within a low growth environment, actually tends to be very bullish for the setup for equities as we go forward. So, this last inflation print, as we looked at it, very, very similar to the ISM print that we saw this jump in inflation even though growth was relatively stagnant. It did go down a little bit for us, but the jump in inflation obviously puts us in a zone that's looking at really average to below average returns as a setup, right? As we see it historically. So what we'd really like to see, and you can see some of these variations, the dots represent on a shaded basis where we've been over the last 6 months, right? So we've kind of made this circle and then jumped up here most recently. So yeah, it's been kind of off and on in a bullish zone, and now it's starting to move into a more neutral zone. I don't think it's outright bearish, but certainly doesn't have the same kind of table pounding conviction, if you will, as when we're in this sort of consistent low growth, low inflation, or low inflation, improving growth environment. So that's our setup here. And I would say, one of the things that I think we're very well known for is looking at kind of the big picture and saying, hey, here's what should be happening given the history of the world and the history of the markets, and then aligning what actually is happening, where there's consistencies and where there's inconsistencies, and helping to make those bets or overweights or underweights based on kind of that juxtaposition of those two things aligning, not only the current reality, but what that reality is saying historically should be.
Interesting. I love that framework because when you look at the bottom left, when I see that, I just think about the regime from basically 2009 to 2020, right before COVID, where we had low inflation, somewhat low growth too, but still that provided that tailwind for risk assets. And now we've shifted into this regime where inflation is a lot more ever present in a lot of different factors. I would love to hear about how you're trying to piece apart the obviously you try to quantify it down into this specific regime that you can move around in on, but it feels like there's a lot of noise in the economic data. You mentioned the ISM prints that came out this week. We had the services print this morning. We had the manufacturing print earlier this week, and it feels like what's happening is we're all trying to figure out how much of these economic data prints are being influenced by tariff concerns, fiscal concerns. We've seen a huge amount of imports front running these potential tariffs, and that's making for some weird data prints. We're seeing upticks in manufacturing PMIs. Trying to figure out is that a tariff front running thing, or is that like a rebound in the manufacturing sector after being lackluster for the past couple of years? So how do you think about these very unique situations that we're in right now and bringing that into your high level regime there?
Yeah, no, they're great questions because there are a lot of cross currents going on, and we don't have a mandate at our firm, right? So if Neil's calling for a recession and we see a bull market, it just is what it is. We don't impinge on other people's sort of intellectual property and thought process. But I would say we're probably as aligned, and frankly, we have been for probably the last 3+ years. In terms of how he's viewing the economy and the same message that we're getting out of markets. And so, I'd say a couple things have developed, and one is that beta. So beta is basically how volatile you are versus the market return, right? So high beta names will be more volatile versus the market. Low beta names will be less volatile than the market. And what we saw back at the beginning of December was high beta in terms of performance versus low beta was in the 99th percentile historically. And that just said that people were really pressing on the beta pedal, right? They wanted exposure. They were getting very good returns for knowing nothing other than whether a stock was high beta or a stock was low beta. And we warned in December. We just said, look, this is unsustainable. This isn't where you want to be, or you want to make sure that you don't have unintended beta overweights in your portfolio because you're vulnerable to some type of reversion. Well, lo and behold, today, or actually yesterday, officially, that beta that went from the 99th percent then got to the second percentile historically. And so I think a lot of the correction that we've seen has taken place in beta. Now, we do it sector neutral, so it's not all tech, it's not all discretionary or comm services. But we did see a disproportionate decline in things like industrials and things like tech. Now, when we look at something like technology, semiconductors, which to us started to flag back in the summer of last year as being vulnerable, that started to then align itself with home builders, with building products, with some of these other very rate sensitive areas of the economy. And so, Neil's call was, look, the economy is slowing and these rates are having an impact and it's going to take a while. So I think you've got this cross current that's happening right now of, yes, we had higher rates that are still working their way through the system and the impacts that they're going to have. And then that's being multiplied or amplified by what we're seeing with these tariff concerns and these tariff threats, right? So I think that's creating the cross current. But when we look at overall trends, and that's really what we try to do, is is distill the signal from the noise. What we see is that deterioration in industrials, and that looks to us to be more real than not. I think one of the things that's very important for listeners and watchers is knowing that at the same time that we're seeing industrials in some areas of obviously beta, but some areas of cyclicality decline, we're also seeing new relative strength highs almost globally in financials and in banks. And that's not something that you'd expect if you're really on the cusp of a recession. So Neil's call, based on the data, based on employment, et cetera, and kind of putting it all together, synthesizing it, is that it's a slowdown, but it's not a recession. It probably is not going to feel good. But if that's the case, and I would say our work would be consistent with that, that means that the oversold condition in equities is probably viable. It's unlikely to be a top. I think there are pockets that are still vulnerable, like those industrials, but for the most part, that's still in a pretty good framework. And again, it's been more consistent recently with between Neil and myself and our interpretation of the market. But those two things seem to be conjoined here.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah, that's a really interesting take, because I feel like, when a lot of folks look at this current equity sell-off, especially in the S&P 500, et cetera, it feels like, there's this, recession-y panic that's starting to be thought through the markets right now. But it sounds like it's more so just this rotational aspect that's happening right now. Like, to your point, if financials are soaring, it's hard to square that with a potential growth slowdown, or even more so a recession, especially. So how are you thinking about how that rotation is evolving? How are you thinking about like growth to value, large cap, small cap? Obviously, you already just mentioned high beta has been the thing that people have been riding, and it feels like there's just this shakeout happening right now. But how are you thinking about other, equity sectors as they stand right now?
Yeah, it's a good question. So there is a seasonal component. I didn't send you the chart, but there is a seasonal component, believe it or not, of cyclicals to defensives. And defensives tend to actually outperform as we get into the kind of mid-spring into the early fall. And so there is this shift seasonally. Now, there are some areas of defensive that look pretty interesting to us. I'd say utilities is one. Utilities are actually one of the leadership groups in this market. We would say, and this is subject to change, but we would say right now this is probably more of an interest rate recalibration from 475 to 415 on the 10-year. But it might very well be, indicating or morph into a less optimistic outlook for equities. If you said one of the things that we measure is utility performance versus financials, and that hasn't given way yet, so it still says that we're okay. But if you start seeing utilities outperform financials significantly, it's usually a sign for us that, hey, something else is happening here that's probably a little bit more bearish than the normal course of action. So utilities look good, financials look good for us. I would say, from a valuation standpoint, we will make contrarian calls when three things happen. One, the sentiment is so god awful that nobody's left, and we often will hear the term uninvestable, right? I mean, that's music to my ears when I hear the term uninvestable. For an individual security, no, but for a group or for a sector in particular, absolutely, because it just is this pervasive thinking that people are all fishing from one side of the boat, which tends to be problematic. The other is some type of valuation support, right? So if I've got some type of valuation support, that's always interesting to me. And then finally, we'll look at relative performance and just say, hey, is relative performance starting to improve? So the two areas where the setups are there, and I would say actually, a little further along in this incubation period has been REITs. REITs are still cheap in our work. The sentiment is negative. There's a couple ways we measure that. We measure that through positioning in ETFs and what those flows are. Are people buying more? Are there inflows? Are people selling more? Are there outflows? And right now we're seeing outflows in ETFs. We're seeing some of the option activity start to to press or try to exploit the downside versus the upside, and that's usually a good sign. And then we've got relative performance. The relative performance, slowly but surely, trust me on this, has started to improve. And so we're just saying, look, we want to be very careful of cheap things that are going down because those tend to be value traps, and we have to be, really, really careful with those types of situations. In fact, we've done a lot of work on that, testing it statistically, and by all means, cheap going up is far better and far better returns than cheap going down. So we always wait for that turn and kind of let the knife hit the floor before trying to pick it up. So we're seeing good things in REITs. The other side of the ledger, and this is the cheapest in the market from our work quantitatively of all sectors, is energy. So energy is very strong from a free cash flow to enterprise value, particularly relative to the market. It looks very, very good. When we look at sentiment, we're seeing excessive outflows in the XLE and those types of energy ETFs. So that's a good setup. The problem is we don't have relative yet. So there's been no turn. And for us, that's kind of like being on the starting block, but not having the gun go off, right? So we're ready, set, but we don't hear the go. So, we'll be, people are kind of thinking about how we're going to think about things. Breakouts, relative performance, improvements there are good. And that'll get us to start pressing into those names. One of the ways that you can play that, a lot of people just want to buy value because it's cheap, and I understand it, but I can tell you statistically, you got to be very careful doing that. One of the ways is just play it very, very small now. If you want to play just for the value component or the contrarian component of the outflows, and then add to those positions as you start seeing breakouts. And by the way, pay attention to what's breaking out. Pay attention to where the trends are improving, because that's likely to be leadership and give you the best return, particularly on a risk-adjusted basis as you go forward. So, the contrarian call in us would be REITs and energy here, more so REITs than energy, but those are interesting. And then for the overall market, look, I think there's plenty of tech names that are getting oversold. Those look pretty interesting to us, actually. Not all of them. I think AI is probably overhyped and still dangerous. I think semiconductors are still dangerous, frankly. But there are software names, there are hardware names, communication equipment names that still look good, social media names that still look good. So I think there's still opportunities there. It's probably not as ubiquitous as it was a year ago or 2 years ago, but I still think that there's opportunities. And then finally, we're looking at discretionary. So discretionary is slightly, and I mean slightly, overweight in our work right now. And it could go either way, but that will be one of the things that we're watching. If discretionary breaks down on us and fails to respond well to this oversold condition for the general market, that's a sign that the deterioration of the economy is getting worse and worse and worse. Now, one thing just to mention on discretionary, because I do think it's important, if you look at that market cycle clock I showed you, we do it for all sectors. And what's really interesting is in that cycle clock, that bottom left, where the green boxes were, for discretionary in particular, that's the best zone. The bottom left is the best zone. And if you think about that, I mean, if you're to ask Neil what that zone represents, he'd say that's called the deflationary bust, right? That's where we were in 2008, 2009. That's where you get in, some of these kind of, it doesn't feel good. What's interesting is discretionary is one of the best contrarian sectors that's out there. When we look at the news flow and what you'd expect from the economy and kind of just logically thinking about it, the consumer discretionary names do far better when the news is bad and far worse when the news is good. And I think that's really just a representation of they are looking at the Fed, right? And if the Fed's easing, which they're going to be in that bottom left-hand zone, that's going to eventually be good for discretionary names. And so they start to get bid in that bad news environment. And when things are good, the presumption is the Fed will step in and start to take the punch bowl away, and the discretionary names see that and start to act accordingly. So again, kind of that market leading the data, if you will, and waiting for the expectations.
Speaking of value traps, the first thing I think about is emerging market equities, and especially European equities, which have been, the mother of all value traps for it feels like 10 years now. But
Yeah.
it's quite interesting to see what's happening right now when you pair sentiment of, it feels like going into 2025, everybody was on the boat of US exceptionalism, hide out in US equities, a lot of people hiding out there. And then we're starting to see this interesting dynamic, like some news hit the tape last night about Germany is taking off the fiscal shackles and talking about, bringing forth 500 billion in infrastructure investment. So it's like, you pair that with what we're seeing with European equities right now, which have been doing better than US equities so far this year. So how are you thinking about the emerging market equities, and especially Europe there?
Well, emerging market for us is different than obviously Europe, and I think that's probably true for you, because I just want to make that distinction. Europe looks unbelievable. I mean, it really does, and I think it's a great example of kind of defying the expectations and defying the logic, if you will. And I would even put a pin on that by saying the banks in Europe look fantastic. Now, that comes after a decade plus of talking to people that say the banks are investable because nobody knows what the balance sheets are, right? The sheets aren't clean, nobody knows what it is. That seems to be changing. So there's some dynamic that's taking place that is changing there for the better. And again, when banks are leading, it tends to be a decent sign for the markets. On an EM basis, what we really like, and we've liked China for the entirety of 2024, we still like it a lot. And again, that was that combination. We saw sentiment, which if you kind of rewind a year ago, sentiment was apoplectic. I mean, people were absolutely, against anything that was Hong Kong or Chinese related from a security standpoint. So that was good news to us. We knew the sentiment environment was right. You started looking at the Buffett indicator, market cap to GDP, et cetera, well below 100% on each one of those, right? So the stocks were trading less than what the GDP expectations were, or actually GDP. And then we finally got bullish technical confirmation, right? We started to see momentum develop. We started to see these base formations break out. We started to see moving averages cross over and improve. And so I think that's a long play game. But I think China, when we look back 3-5 years, will probably have been in good shape. And I think there's a lot of linear thinking going on there. Trump and China. We would look at it and say a lot of that's been probably discounted. And if anything, the situation of the economy in China probably brings them to the table with more concessions than fewer, right? And so when we look at this and view this through the lens kind of holistically of what we do historically and look at other bottoms, I would equate this to the 08, 09 moment in the US for China. Like I think it's really that kind of turn. So the difference is, and I think this is an important part for viewers and listeners, this notion of buy and hold in terms of indices, and that's the path to fabulous wealth, is really a U.S. exceptionalism story. If you look at Europe, if you look at China, you look at Japan, those have not been, buy and holds have not made you rich. So I think it's one thing to keep in mind that's just something that has tended, maybe it doesn't last forever in the U.S. And so when we talk about things like this, it might be within the context of, hey, this is going to work for several quarters or maybe several years, but there's probably some type of trade element or shifting of the allocation that we need. But right now, we think that there's a big bottom taking place in China and in Hong Kong. And honestly, the Hong Kong semiconductors, the Chinese semiconductors look exactly the opposite of U.S. And that's pretty unusual because globally, partly because of trade. But if you've got, bullish pharmaceuticals here in the States or bullish pharmaceuticals in Europe, you probably have bullish pharmaceuticals in Japan and around the world, right? So they're highly correlated globally. This has not been the case, particularly for tech in China. And I think that's pretty interesting that maybe there's some revolution taking place from a technology standpoint in China. Maybe they're closer with DeepSeek and some of these other things than we care to admit too.
Do you think a Chinese yuan devaluation is required for continuation on that, or do you think we could still see an uptick in the economy and liquidity over there without it?
Yeah, I think if they throw stimulus at it, you probably don't need it. I think it would help the devalue, but I wouldn't say that currently, I would not say that devaluation is necessary for the bull market because it looks like it's starting without that, right? So, if there was kind of a cause and effect, I could see that, but I think it's more kind of recognition of, hey, we better get things in. I mean, look, I understand people don't trust the communist leadership. The one thing I would say around that is, do you trust their own self-interest, right? And I think everybody trusts people have their own self-interest. And so within that, they're probably going to do whatever it takes, kind of the Mario Draghi moment for them to stay in power, right? And I think that is through economic growth and probably better relations globally.
Okay, I want to shift gears a little bit into fixed income, and I want to start off by just getting your outlook on monetary policy as it stands. And I'm just going to pull up a chart you have of the 2-year here just to frame that up. But there's been a lot of change recently. We've gone from back in December, we've seen this somewhat hawkish pivot from the Fed and moved into this dot plot forecast that effectively only had a couple cuts priced into the curve. And then pretty quickly, the market even got more hawkish than the Fed at one point there. And we saw almost no cuts being priced for 2025. We're now getting to, I believe the last I checked was around 3 cuts for the year. And we've seen a pretty substantial rally in the 2 years. So how are you thinking about monetary policy and how that reflects in the fixed income here?
Yeah, look, I think in fairness, we've thought, Neil and I, for probably 9 months now that yields were topping. It's easier to say now that they're down from that, but it wasn't easy to say back in the fourth quarter when we still thought that was the case 6 months prior to that, right? So it's been a tougher call for us. I mean, directionally it's been right, but it hasn't been easy, and it's certainly not a victory lap by any means. But I think there was a couple things that stood out to us that conditions were too tight from a monetary standpoint. One was the Fed fund to 2-year curve was absolutely inverted, right? In other words, the Fed was much more hawkish and stringent than the 2-year note was reflecting. It just said that that's kind of a short-term subsidy, if you will. I mean, if I were Fed governor, I would say, look, we're going to try to peg the Fed fund rate as close as we can to the 2-year yield, with the idea that will no longer provide a subsidy nor a restriction to monetary policy. It's going to be right in line with the markets. And then, under extraordinary circumstances, COVID, extreme inflation, et cetera, then we can adjust from that. But for the most part, let's try to keep it as close as we can to the 2-year yield, because that's basically the market's clearing rate, right? The things that were supportive of, so that was restrictive. That said that the Fed was too tight. At the same time, we were looking at credit spreads, and credit spreads were very close to all-time tights, right? So it was saying the economy, the price of credit within the market was still very actively and well bid. So people were not, discounting a recession. They were not discounting declines in aggregate demand, et cetera. And so that's been the tug of war here, that you've seen a lot parts of the curve. I mean, we had just the traditional 2s versus 10 inversion for, I think it was historic at this point, right? The longest that we'd ever seen. So you had some of the traditional curve metrics that were telling you that policy was restrictive, yet when we look at, and we always talk about this, the symptoms of credit, right? Because we can't really tell. If you told me it's going to be $6 trillion, I don't know if that's a good number or a bad number, but I can tell you from the market's reaction what it thinks of $6 trillion, right? So when we look at it, the symptoms of credit were really a mixed bag. And I think the Fed, frankly, has probably done a decent job. We absolutely think they were slow off the starting blocks to try to get inflation under control. But I think given the mixture of the data, they're definitely slowing some parts of the economy, housing, the things that you would expect with the elevated rates and having the impact on demand. But they're not crushing employment yet. They're not crushing other aspects of the economy, which seem to be, the consumer included, seem to be at least okay and holding in there. So you look at things like cruise lines, you look at things like hotels, some of the other less meaningful spends than saying home building, or for example, or autos. I mean, the way I describe it is like if you have to ask your spouse whether or not you can do it, that's the discretionary that was hit, right? If you have to go out and buy a pair of shoes, it's probably not a big deal, right? So the big ticket items certainly were under pressure. The littler ticket items are still okay, but those are certainly worth watching to see if we become even more restrictive from here. So my policy outlook is going to be right around in line with the 2-year yield. We think the 2-year yield probably goes somewhere close to 350. So you can imply from that's what we would be thinking. Call it 12 to 18 months out from a policy perspective.
I'm just going to pull up the 10-year here. I feel like this is a bit more of a muddier situation. There's a lot of different cross currents on the long end right now, and love to just hear about how you're thinking about it, especially in this significant rally. Obviously, we had in the lead up to the January inauguration quite a uptick in yields there, as it felt like a lot of people had a lot of different reasons for what that was, either the unpricing of the recession or fiscal concerns of Trump, et cetera, et cetera. There's a lot of different reasons, but we've seen the reversal now. We're getting pretty close to your target here of 415. So I'd love to just hear, what do you think are the main drivers stand here, especially from that like fiscal side of what's going on with Doge and other fiscal contractions there. And then also, do you think any lower here on the long end, is that basically a call on recession at that point? Do you feel like this gross slowdown has been priced into the long end? What do you see there?
Yeah, those are great questions. I mean, we feel like anything above, say, 375 is probably okay for the market and for the economy. Um, we're kind of believers of the 2% inflation plus GDP, right? And then looking at that for the 10 year as a rough guide. We thought, we could see it in the sentiment data. We thought that around the Trump election, we thought there was a lot more sort of emotional concerns around long-term issues that probably weren't practical in the near term. And I know there's some legendary investors that are on the other side of this, thinking that we're going to go to 5, 6, maybe 7% on the 10-year yield, and maybe that happens. But it was just so concentrated in something that was going to be such a long-tailed event that it felt like a bad bet at that point in time. That's proved to be right, at least in the near term. This is still a mixed bag. From a technical standpoint, you basically have a cap at 5%. You've got a floor at 350, and right now we're oversold. Within kind of this neutral trend, which says we probably should get some relief here from the yields being low to yields bouncing somewhere, I'd say, 435 or something along those lines. I'm not in the camp yet that it's out of control, and some of these things that people are talking about are that problematic. Again, because we don't see it in corporate credit, we don't see it in other areas of the system. I understand philosophically the concerns. I can totally see that, but we try to listen to the market's message and not put forth our imprint of what we think philosophically should be happening. And when we take a step back, and again, it's not a real clear picture, but the path of resistance is probably more stable, lower yields in the near term. No, we're likely to bounce, but I do think we're going to be somewhere between, call it 450 maybe on the upside, and 350. We set a high of 5, but I don't think that we're going to get through that. And below 350, if we do that, I think that is bad news for the economy. So the good thing here, and this is where we were not back in the fall, is we have what we call our yield impact model, and the yield impact model just tells us what the not only the rate of change but the level of yields are that start to statistically impact the performance of the S&P. And we were in this 90th to 100th percentile for our yield impact model back when we were above 450 or really 475 on the 10-year. It just said, hey, that's going to be a struggle for the S&P because now you've got a competing assets, and historically that's not great news. So now that we're at 415, it's actually been more bullish for the S&P. So there is part of that I think that people kind of forget about, right? Where when you bring these rates down, particularly if they come down in dramatic fashion, that tends to be at least some type of floor for stocks. And I think that'll prove to be better news. So do we need lower yields for the market to end higher on the year? I don't think it have to be substantially lower, but if we have 5+% yields, I think that's going to be a hard call to have a decent year for equities.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Do you think that yield dynamic is why, just looking at the price action yesterday, we saw NASDAQ lead while Russell was struggling?
Yeah, I do. I mean, the Russell, there's a lot of people that want to own the Russell because it's cheaper. I get it. Keep in mind that there's a sector weight differential that's really skewed towards financials, which should be good, but it's also skewed towards some of these lower end biotechs and some other things that are a little bit more speculative and just have a hard time getting out of their own way. When we look at the data historically, there's nothing in our work that says we should be making a big bet versus the large cap names. It's a mix, and so I think there are some pockets. Frankly, healthcare does look a little bit better in small cap than it does in large cap. I think there are some pockets here and there, but I don't think it's enough to make a definitive, small versus large call. If you wanted to do it based on valuation, we just say tilt, make a small adjustment, but we don't really see some big catalyst that's going to drive the small caps here.
I know you mentioned credit spreads a couple times already in the show, but just want to double click there and clarify your perspective on those. if one is in the camp of either an aggressive slowdown or growth scare or even recession, you might think that credit spreads should be wider than they're at right now. What's your perspective on credit spreads there? I've heard a lot of talk about how, just the the amount of growth that we've seen in the private credit world has kind of skewed the perception of what these publicly facing credit spreads might be saying versus the private side of things. But yeah, how do you think about that? And do you feel like it's fair where it's at right now?
Look, I would not buy credit today. I mean, so while we're bullish because that's a bullish indicator, I'm not saying it's cheap, right? In a lot of
Yeah.
ways, it's
Yeah.
just the opposite, right? So that's important distinction. Look, we still see it, and we measure it in so many different ways that we really try to circle the wagons and come at it from a lot of different perspectives. And really consistently, we still see that credit is well priced. Is it overpriced? Maybe, but that can go on for an extended period of time. And again, I think it's more bullish than not for the overall equity environment. Howard Mason, who does a lot of good plumbing work for us versus the Fed, QE, QT, et cetera, thinks that QT probably comes to an end sometime, around July, sometime in the summer. And so you've got this, kind of competing aspect of treasury issuance and treasury buyers and sellers that are coming together and probably going to be more normalized, within the next 4 to 6 months as we get closer. So just something to keep in mind there. But the credit spreads, look, as much as I'm not interested in owning those here, they're still sending a more bullish message. And we have a rule. I mean, we measure the significance of our data over time, so we're really vigilant around that. There is a hot hand effect in this business. Sometimes indicators are great for extended period of time, and then they go cold. So we try to understand like what's improving and what's deteriorating. And there's nothing yet in credit. And I always worry when this time is different because we're doing something different, but the indicator hasn't lied to us yet, right? It's when the indicator decides to lie to us once or twice, then I think it's worth not trusting, but until it lies to you, I think you have to trust it, that it's got, the same characteristics and property and, constitutional fortitude, if you will, that it's had in the past.
The last thing I wanted to talk a bit about is what we've been seeing in gold, and also in pairing that with how you think about digital gold, the Bitcoin. You had a chart in here just looking at the oversold nature of it right now. But would love to first hear what's your outlook for gold? It feels like it's just on a relentless bull market going against any of these, historical correlation factors like real yields or et cetera. It just keeps, grinding higher. Um, Not sure if you think about how you think about Bitcoin as just like a proxy to leverage cues or something like that, or if it's more closely related to something like gold. But would love to just hear about how you think about those two asset classes.
Yeah, look, gold is relentless, and I think what is different on gold. So from a U.S. perspective, the best relationship for gold is consumer sentiment. It's not inflation, it's not deflation, but when consumer sentiment is low, or particularly when it's kind of middling and trending lower, gold tends to do very, very well. And that happens both in inflation and deflationary environments. So a lot of people love to kind of force this M2 mechanism on gold and say, look, this is why gold, good luck. That the T stats on that are frankly, they're negative. So they're going to do just the opposite for you. So be really careful with that. That's kind of this, what we call the chalkboard theoretical, trying to force the square peg in the round hole of the realities of the market. So there's a lot of that in this business, believe it or not. So the way that we're looking at gold, and you can see it in some of the flow data, is it's really this move away towards dollarization, right? So it's happening in Russia, it's happening in China, and that is the potential downside of asset seizures, bank seizures, et cetera, that happens when we sanction countries. They start to say, well, why are we beholden to the dollar? We need it for trade, but we need to diversify away from that. And that's, essentially what you're seeing in, we think, at least in the demand side for gold. So less about inflation, less about consumer confidence here because it's a global asset. And that was happening as the dollar was rallying too, right? So that was a little odd, but it's usually a global perspective when the U.S. Relationships are no longer, as extreme or valid.
And then how do you think about Bitcoin here? I'll just pull up the chart you pull it here.
Yeah, look, Bitcoin's in an uptrend, and this kind of gets into that philosophical, right? Do you really believe in fixed supply, and is that have value? And then what's the confidence game around that? And Is it really just used for illicit activity? And I mean, there's all that stuff we don't need to get into because I don't think it's all opinion based, and it's going to be really hard to nail that down. If you look at the world the way we look through the world, which is, do trends persist, and do they historically persist for Bitcoin and cryptos? The answer to that is yes. It is a trend following security. And if we're in a trend following security, then for us, when we've identified an uptrend, which we do quantitatively, but there's a lot of different ways to do that, then we want to be buyers of oversold conditions in those uptrends. And we use this proprietary measure called the Renmac oscillator to do that. So when the Renmac oscillator gets below -3, which is that bottom pane there, what it's telling us is the price today is 3 standard deviations away from what we would expect that price to be given the trends that are in place, right? And anytime you get below -3, it's oversold. Anytime you get above +3, it's overbought. So as long as we've got this kind of consistent uptrend in place, we want to try to take advantage of oversold conditions in those uptrends. I think that's exactly what Bitcoin is doing for us right now. And with that, you could make the case that it's also good news for the NASDAQ or the NDX because it represents more or less kind of loosely these animal spirits. And you don't want too much speculation, but you want healthy amount of speculation, in a bull market. Too much speculation obviously is troublesome. Just kind of the right mix, particularly within a correction, is good because it keeps people honest. So I think this is good news for risk assets. I'm not going to make the philosophical leap that it's, the new gold, but until it tells us differently, we think that this is still in an uptrend.
Well, did a huge rally around a lot of different asset classes. I just want to end here with just asking you, what is your one highest conviction bet or view for 2025 if you had to hold yourself to it?
Oh, that's great. I think it's China. It's in full disclosure, it's my largest overweight personally. We've had a long call on this. I think this is the beginning of something long term. We are not day traders. We are not really interested in the next month. I mean, that can be influential. So we want to make sure that we're keeping some pulse on the neck of the short term. But really, we're looking out 6, 12, 18, 24 months. And when I see that combination of things that we're seeing in China, I think it's really, really important and noted and noteworthy. So we'll see how that ends up playing out. And I'm not bearish on the S&P. I think the S&P is okay. We started the year thinking that we'd have a correction in the first quarter. We thought the year would be 13, 15%, something like that. So decent year, not a knockout. But we thought that it could be a really good year by waiting for oversold conditions to develop in the first quarter, which we're right in that zone today. And then using that as the jump off point for, kind of the targets for the remainder of the year. So I know there's a lot of concerns out there, and maybe just one chart to show, just to maybe put people's concerns to rest, is that policy uncertainty index that we have. And this is an index that was developed by Baker, Bloom, and Davis out of Stanford, and it measures the news and the policy uncertainty around news. And one thing that we try to remind clients of is when there's a high degree of policy uncertainty, that's where those green arrows come into play. It's usually near some type of interim low, and so it's a very hard. I understand the mental wiring here, but usually the worse the policy or the higher the policy uncertainty, the returns for the market going forward tend to be good. And that's because, one, policymakers tend to, do something different if things are going bad enough. And two, by the time that has kind of resonated or percolated throughout the system, it's impacted overall sentiment. And that's what we're seeing with the AAII data, where there are a lot of concerns out there. And generally you want to buy the fear and not run from the fear. So when we look at this within the context of that uptrend and these other things that we've talked about with credit and the like, we think this is probably more opportunistic for the bulls than it is for the bears.
Awesome. Very well said. Well, look, Jeff, it was great to have you on the show. We're really honored to have you here. Where can folks go if they want to hear more about Renaissance Macro?
Yeah, you can go to Renaissance, Renmac, I should say, RENMAC.com. And you can subscribe to a trial of our work where we're Neil, myself, Steve Pavlik, Howard Mason. We put out different ideas throughout the week, and you can get a newsletter on that and stay posted. Thank you for that, Felix.
Awesome. Thanks again. Appreciate it.
Take care.